The following radio program is for informational purposes only and is neither specific nor tailored financial advice to any individual. It is not intended as an offer or solicitation for the purchase or sale of any financial instrument. Always do your own due diligence and consult a financial advisor before making any investments. Investing involves risk, which can result in the loss of any or all principal. Peter Weitz is a registered investment advisor with Fusion Analytics Investment Partners, LLC, an SEC-registered investment advisor, as well as a registered rep with Fusion Analytics Securities, LLC, a FINRA registered broker-dealer and SIPC member. All views expressed in this program are those of the host or guests and do not reflect the opinions of Fusion Analytics Investment Partners nor its affiliates. Your investments. How secure are you that they are secure? Do you want to know more about investing, retirement, and moving to the next level in business? Welcome to In Black and Weitz, featuring host Peter Weitz. Our program will answer all of the questions about your future and so much more. It's all about smart business and smarter investing. Now, here is your host, Peter Weitz.
Hi, thanks. Welcome back to the program. I'm your host, Peter Weitz. Big thanks to Tony Boyardi for being on the program last week and giving us the real truth about the oil industry. This week, I'm going to talk a little bit about the markets, give a little bit of recap as to what's happened this year and what we think is going forward. The reason is I've been getting a lot of calls and emails from people asking us our opinion about the markets, and we've been posting on the blog in Black and Weitz a lot of data as it relates to the markets. And so I want to make sure that I give you all an education as to what we really think is happening and why. So let me just give you a sort of an overview of what's happened so far this year. And I want to tell you that 2014 really started out poorly. There was a brutal and seemingly never-ending winter, which brought a lot of activity, particularly in the retail sectors, to a halt, kept shoppers at home, and that was primarily through much of the country. Down here in South Florida, we're kind of immune to that, but it does impact us from an economic perspective around the rest of the country. But the final first quarter estimate told the story, with real gross domestic product contracting a much worse than expected 2.1%. Okay, but there was a reason the equity markets kind of shook off that number. It was, after all, it was yesterday. It was old news. So what today and the rest of the year look like are much different, as we believe manufacturing and jobs appear to be accelerating. Auto and retail sales are on the upswing, and even the housing market is showing some signs of pulling out of its funk. The government's estimate of second quarter GDP was well above the consensus, 4.2%, and it's in line with our view that the economy is settling into a higher growth plane that will drive equities to new highs this year and into 2015. So briefly, I'm going to tell you some of the things I'm going to talk about, then I'm going to expand on them. The first is that economic growth should accelerate with improving fundamentals, creating the foundation for equities to reach new highs. Job growth is expanding at its fastest pace in decades. Okay, manufacturing is a significant source of strength. Rising consumer optimism, increased savings, accelerated job growth, and the wealth effect should underpin back-to-school holiday spending going forward. And housing, though, remains a bit of a mystery. Sales have softened even as builder optimism has seemed to risen, and the Fed finally appears set to raise its target rate next spring, if not sooner. So history suggests equities should fare well in such an environment. Bonds, really not so much, which was a pretty good play off of what happened last year where the bond market didn't do much either. So, some question about the spring's bounce back, and if you followed the market, you'll know that we did recover what we lost in the first quarter. Okay, we'll carry over into this year's second half, and particularly as we get into the final quarter of the year. We believe that strong improvements in the labor market, as I mentioned, auto sales, manufacturing, consumer spending, are representative of an economy that's beginning to click on all cylinders. It's abetted by extremely accommodative central banks here and abroad, and a slowly improving European economy, although we've commented recently on what's going on in the Middle East and how that's affecting Europe, but it's still slightly improving. Japan has been accelerating, and China appears to have successfully navigated a soft landing. putting a dismal first quarter now in this distant past, right? We're projecting GDP to expand at an above rate for the rest of the year and at least through calendar year 15. This in turn should cause, we think, Treasury yields and stock prices to rise significantly before year end. So my first comment is for those that feel that the markets are creeping at these unusually high peaks, both the S&P 500 and the Dow Jones Industrial continue to set new highs. Our goal or our thought process is that that's going to continue based upon the economic data points that we've looked at and evaluated throughout the year and what we think is going to happen going forward. So simply put, we believe this bull market has more to run in our view, and government bonds are going to be enjoying their last gasp before potentially going into a long and prolonged sell-off. So there's a theory with regards to the Dow, and it basically says that the market should continue to be in a bull market as long as the upward trend of both the Dow Industrial and the Dow Transportation averages advance together. In other words, if one of the averages makes a new high in price above a previous important high, it needs to be accompanied or followed by a similar advance in the other average. And so this theory, the underpinning of this theory is that industrials are a reflection of the economy's output strength. Thus, if the industrials are making new highs, it suggests the economy is in good shape. In lockstep with this, if the economy is in good shape, then the transportation stocks and the average should also be doing well since they deliver the output of the industrials. That said, the transports indirectly track consumer demand or strength. So when both indices are making new highs, you have what they call a Dow theory buy signal with strong consumer and strong demand. This moment, thus, the Dow theory buy strategy, the Dow theory buy signal is still intact. And for that reason, we believe, with all the things that are going on, that we're still in a piece of this secular bull market. So let's talk about job growth. After this difficult winter that we spoke about, that put job growth into a deep freeze, literally. But the labor market's bounced back since then. The monthly non-farm payrolls have expanded an average of 244,000 jobs from February through the end of July. If this pace is sustained for the year, and there are reasons to believe that it will be, it would be the biggest annual increase since the latter stages of the go-go 90s in terms of job growth. Importantly to this, the bulk of the gains continue to come almost entirely from the private sector. There has been a pickup in state and local government hirings in recent months, However, the vast majority of these gains come through the private sector, a trend that, if it continues, should keep overall job growth running at a crisp pace. Manufacturers, the second point I made, still remain busy, The pickup in auto sales particularly is helping manufacturing, which snapped back from this deep winter chill. The National Manufacturing Index surged to a 3-year high of 57 in July, substantially better than the contraction reading in May of 2013, where the index was at 49. That helped drive a powerful inventory restocking cycle in the second quarter as businesses nearly tripled their inventory. Industrial production enjoyed its strongest second quarter in 4 years, and capacity utilization has been running at roughly a 6-year cycle high for the past 4 months. Capital goods shipments, which are non-defense and non-aircraft related shipments, which feed directly into gross domestic product, were up 1.4% in the month of June alone, after slipping the prior 2 months leading up into June. So we feel that that's going to pick up and further as businesses feel more confident about the economy and their own need to address capacity and enhance productivity. So in layman's terms, let me sum where we are so far. The markets are, the indices that we look at to determine where the markets are currently at indications that we're still in a bull market run, that there's still a secular bull market on the line. Job growth is at an all-time high from where it was in the 90s, okay, some 15, 17 years ago when we were at robust job growth, okay. We also believe the auto industry and manufacturing are at such highs that companies in the U.S. are continuing to grow, are taking advantage of increased productivity, increased job growth, buying more big-ticket items, and the economy as a whole continues to be really robust and is expanding at, I don't want to say alarming rates, but at really strong and aggressive and sustainable rates. So the last thing I was going to comment on in that regard is that this improving job market is carrying over to consumer moods and spending. Okay, so consumer confidence rose to a 7-year high this summer. Spending, so 7 years, that goes obviously back from 2008 or even 2007, if you were to say it's 2007, 7-year high, right? So spending is measured by personal consumption expenditures increased at a stronger than expected 2.5% in the second quarter, bolstered by the largest improvement in durable goods sales in 5 years. Automobiles alone sold at an annualized run rate of 16.9 million vehicles in June, which is an 8-year high. And at that same time, the savings rate hit a 2-year high of 5.3%. All of this is suggesting that consumers have the ammunition, savings on top of more jobs and income to pick up the pace of spending as they head into the fall season, which includes the holiday season and Christmas time. So everything that we're seeing at the moment indicates that there is no necessity to sell your holdings in the stock markets. We feel quite the contrary. There's still room for growth. The indicators aren't quite at the point where they're telling us that there's going to be some big correction. We had originally thought that in the beginning of the year. And if you actually remember in our show dating back into January, we were a little cautious as to where the markets were going at that time. And now the data points that we're referencing and the data points that we're researching suggest that the winter months, the bad winter that we experienced, really crinked or I want to say really crippled rather what went on inside of the stock market and the equity markets. So all that being said, the markets remain strong. There are some other things I want to talk about with regards to that, and we're going to do that in just a minute, but I want to focus heavily when we get back from the break on the housing market, and I'm going to do that in 2 minutes. You're listening to the In Black and Weitz radio program on the Voice America Business Network.
When it comes to business, you'll find the experts here. Voice America Business Network.
ERISA 408B2, fiduciary standards, safe harbor, fidelity bonds, record keepers, discrimination testing. I am so confused.
Does your 401k plan have more questions than answers? Peter Weitz and his team of 401k experts have a solution. Their on-site service model distinguishes them from other service providers, and they are specialists in 401k costs, regulations, and compliance. If your 401k plan has more questions than answers, then contact Peter at 877-945-2888 or email him at peter@inblackandweitz.com.
Climbing Mount Everest is an amazing feat, and many have died trying to do so. However, more people have died descending Mount Everest than in reaching the summit. Part of the problem may be that people are so focused on reaching their objective that they fail to plan appropriately for what they will do or should be prepared for afterward. Similarly, people are so focused on saving for retirement and reaching retirement that they fail to plan appropriately for what they will encounter once they have actually retired. With 1 out of every 4 65-year-olds today living past the age of 90, you may be retired longer than you are actually working. Have you devised a plan, process, and discipline to ensure that you will not run out of money? If you are not sure what to do, then simply contact Peter Weitz and his retirement team at Fusion Analytics. We help manage human emotions using 3 proprietary investment techniques. Our job is to evaluate the forces that the typical investor can't see so that wealth is preserved and not lost. Find out more at inblackandweitz.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandweitz.com. In Black and Weitz, we win by not losing.
When it comes to business, you'll find the experts here. Voice America Business Network.
You are listening to In Black and Weitz. To reach Peter Weitz or his guest today, please call 1-866-472-5790. That's 1-866-472-5790. You may also send an email to peter at inblackandweitz.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandweitz.com. Now, back to this week's program.
Hi, thanks. Welcome back to the show. I'm your host, Peter Weitz. I'm talking today about the outlook of the markets for the remainder of the year. And I spent the first part of the segment talking about, why we believe the markets are going to continue to roll. And I focus specifically on the jobs market, the manufacturing market, the high levels of consumer sentiment. And I also talked about a theory called the Dow theory, on what's called the Dow theory buy signal, saying that when the transportation index and the industrial index rise to new highs at the same time, it has always historically been a big, strong buy signal for the equity markets. But I'll talk a little bit about housing, because housing's it's sort of been it's kind of been a weird market, and I think it's really been a secular market driven a lot by the weather. But the housing market, it appeared to be gearing up last year for massive growth, but then it got walloped, by this winter, and it's been staggering since. New and existing home sales slipped 3 of the first 6 months of this year, and starts and permits have been drifting down, with the bulk of activity concentrated primarily in multifamily construction, and that tends to have a much smaller multiplier effect than single-family construction, okay? So we still think new homes, if you look at, we talked a little bit about the savings rate has increased. People are really concerned more about having a bigger nest egg, and so perhaps they're buying smaller homes, or maybe even renting houses versus buying bigger houses, or renting condos and apartments, or buying condos, I should say, as opposed to renting or buying bigger homes to be able to keep their expenses at a more measurable and increased savings pace. And that must explain some of the reasons why the multifamily housing sector has continued to shine. But on the plus side, okay, after this plunging during the winter last year, builder sentiment has been climbing, and it's reached a 6-month high in July. So the builders are they're dipping their toe into the water and saying, let's start building stuff again, because the markets are going to come our way. The big question overhanging, I think, the housing market is if and when will these millennials, begin to enter the home buying market. And that's that whole reason why we believe it's staggered. The 1-2 punch of student loan debt and a tough job market has many of these millennials on the fence. But there are suggestions. They may be happy renting as opposed to owning for years to come. And as I mentioned, that socio-demographic shift would have a significant implication for housing. And that's a socio-demographic shift. So housing market, it's interesting to follow, because I think you're seeing a real interesting dynamic as to what people are actually buying. I don't necessarily think bigger is better any longer. I think it's more about savings. The big question now leads to the Fed. So what's the Fed going to do? Well, there's no doubt that the Federal Reserve's ultra accommodation of the past 5 years propped up the economy's recovery from the Great Recession. but there have been some fairly public rumblings, we believe, of late by key policymakers in Congress that suggest a widening rift between the majority doves headed by Janet Yellen and the minority hawks led by Philly Fed President Charles Plosser, with the latter pushing for tightening sooner. So driving this debate has been concerns that core inflation is closing in on the Fed's 2% target, and unemployment has improved to the extent that extraordinary stimulus is no longer merited. But how this total struggle is going to play out could determine whether the target funds rate rises before the late spring 2015, a move currently priced into the market. So there's full agreement, on the other hand, that tapering will continue on course to bring an end to quantitative easing by late this fall. So the Doves-Hawks debate aside, right, we expect longer and shorter rates to begin reflecting an upward bias going into the second half of this year and into later 2015, but not in a runaway fashion. The move should reflect positive fundamentals, which would be based on faster growth in the U.S., a broadening recovery in Europe and Japan, and that's a big if at the moment based on what's going on in the Middle East, and a China that will have successfully maneuvered a soft landing. To be sure, once the Fed starts tightening rates, or once they start tightening, I should say, rates are going to react, particularly we think on the short to intermediate part of the curve. But the reasons for that will be because of economic strength, not weakness. And that's the interesting point. The Fed, moreover, as the Fed eases off of the pedal, we think the actions of the Bank of Japan and the European Central Bank, which are undertaking the sort of extraordinary ultra accommodation the Fed is beginning to end, will serve as countervailing forces that will inhibit longer rates from moving too far, too fast. So we're keeping an eye on what the European central banks and the Bank of Japan are doing as well, as that's going to really make a big difference in what happens in our monetary policy here. So the bottom line is this with regards to the Fed. We believe rising rates, particularly if the Fed acts sooner than expected on the target's fund rate, could cause some indigestion for the equities market, okay? But history tells us that rising rates, as a result of a strengthening economy, tend to be positive for stocks over the longer run, with temporary hiccups typically followed by a renewed rally higher, which is what we are expecting to be the case this time as well. Bonds, of course, don't do well when interest rates are rising, which is why at a minimum we have a very low allocation in our bond strategies. And I'm going to take a quick aside on bonds. When you think about the bond market, and we've been talking about this for a long time, but in a rising interest rate market, if you think that the stock market and you lost on the equities market in 2008 was a hurt, wait till you see what happens to the bond market when interest rate starts to rise. The best way to think about it is to look at it, think of it like a seesaw. I remember when you were in elementary school and you played on a seesaw. When one person kicked their legs up to go into the air, the other person went down. So person A is bond prices and person B is interest rates. So if person B were to take their legs and kick them up in the air as interest rates are rising in that seesaw, right, person A is going to decline. If you then were to look at the length of the seesaw, the pieces of the seesaw that are closest to the center base don't move or fluctuate as much as the pieces of wood or where the actual riders are at the very end of that seesaw. So what does that mean? It means the shorter term bond rates are less sensitive to interest rate adjustments as the longer term bond rates are. And so we're seeing a important piece here is that you really want to shorten your bond durations as we go into 2015 if we believe, and we do believe, that the Fed will raise rates, because the short-term bond rates will be less sensitive to price fluctuations than in the long run. We've spent many shows talking about the importance of active versus passive management. And, I've never been a big a proponent of indexing. In some cases, it does make a lot of sense, but in some very particular sector funds, it doesn't. And for those that are heavily invested in the Vanguard area, the Barclays Ag is how Vanguard manages its bond funds, particularly in its target date funds and others. So the Vanguard sort of generic bond fund uses the Barclays Ag. Well, the Barclays Ag is not subject to interest rate sensitivity, and in fact, it's fairly long on the yield curve. That being said, the longer term bonds are going to get creamed. So if you're a Vanguard holder of bond funds, I'd be very careful in how you manage them as you get into the sensitivity of rising interest rates. I don't have the data in front of me, and I'll try to get it at the break, but a 1% increase in bond rates, I believe, drops your price 12%. So a 1% increase in interest rates drops your bond price 12%. So if we head up to these 4 or 5% interest rates that we had in the early 2000s, think about how much principal you're going to lose in your bonds. And for us down here in South Florida, where we have a lot of fixed income retiree people, we have to be very careful about managing their fixed income in their bond portfolios because they rely on that income as a means to sustain their living habits while they're in their retired phase of life. So that's my sort of theory on where we are in the bond market. We looked at some other research in this regard, and we got some research from a gentleman named Jeff Gundlach, who's the CEO and founder of Double Line Capital, and he's a widely followed hedge fund manager the last several years, just to sort of counterbalance where we are with our data, just to see if he's on the same page. And he actually spoke to CNBC several days ago, and I'm gonna share some of his thoughts with you as well. So one of his main themes was that he sees the benchmark 10-year Treasury note 10-year yield staying in a range between 2.2 and 2.8%. And that assessment is driven in part by demand from investors who see U.S. yields as attractive relative to other developed economies, particularly Germany and Japan, where yields are much lower. So his first question with him was, where is monetary policy headed? And we mentioned in the beginning, we talked about we believe interest rates are going to start to rise sometime in the middle of 2015. He said during the same interview that he doesn't believe the Fed Reserve Chairwoman Janet Yellen is in a hurry to raise interest rates, even if other Fed officials are, as we mentioned, particularly Charles Plosser out of Philadelphia. But that accommodation may just be the beginning. In an interview, he said that a slow economy may well push the Fed to bring its bond buying program back by 2020. So he's not necessarily so bullish on the economy. However, he does believe that interest rates could rise. His comment on the housing market is that if you want to know what's holding back the economy, look no further than housing. He believes it will suffer from continued demographic shifts away from home ownership, and he suggested shorting the home builder exchange traded funds during an investment conference in the spring. And so that mirrors really what we were talking about with housing, as we said that the socio-demographic shift goes from people not wanting to own homes, not wanting to own as bigger homes, and a really strong push into the rental multifamily market versus home ownership. There's significant cost savings without having home ownership. And we don't necessarily believe we're going to have the home appreciation values that we had in late 2006 through 2008 as we saw the housing bubble. So, in terms of an investment, we don't really know if that's a good place to park some money. So there's a big socio-demographic shift, as we said, back to rentals. I'm going to give you a comment on junk bonds because junk bonds are important, but I'm going to do that in just a minute. We're going to take a quick break. You're listening to the In Black and Weitz radio program on the Voice America Business Network.
From the boardroom to you, Voice America Business Network.
Climbing Mount Everest is an amazing feat, and many have died trying to do so. However, more people have died descending Mount Everest than in reaching the summit. Part of the problem may be that people are so focused on reaching their objective that they fail to plan appropriately for what they will do or should be prepared for afterward. Similarly, people are so focused on saving for retirement and reaching retirement that they fail to plan appropriately for what they will encounter once they have actually retired. With 1 out of every 4 65-year-olds today living past the age of 90, you may be retired longer than you are actually working. Have you devised a plan, process, and discipline to ensure that you will not run out of money? If you are not sure what to do, then simply contact Peter Weitz and his retirement team at Fusion Analytics. We help manage human emotions using 3 proprietary investment techniques. Our job is to evaluate the forces that the typical investor can't see so that wealth is preserved and not lost. Find out more at inblackandweitz.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandweitz.com. In Black and Weitz, we win by not losing.
ERISA 408B2, fiduciary standards, safe harbor, fidelity bonds, record keepers, discrimination testing. I am so confused.
Does your 401k plan have more questions than answers? Peter Weitz and his team of 401k experts have a solution. Their on-site service model distinguishes them from other service providers, and they are specialists in 401k costs, regulations, and compliance. If your 401k plan has more questions than answers, then contact Peter at 877-945-2888 or email him at peter@inblackandweitz.com.
Voice America Business Network, the bottom line in business.
You are listening to In Black and Weitz. To reach Peter Weitz or his guest today, please call 1-866-472-5790. That's 1-866-472-5790. You may also send an email to peter@inblackandweitz.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandweitz.com. Now, back to this week's program.
Hi, thanks. Welcome back to the program. I'm your host, Peter Weitz. I've been spending today talking about the markets and what's happened in the beginning of 2014 and what our sentiment is with regards to the markets for the remainder of the year and into the first quarter of 2015. I did that because we've been receiving a lot of inquiries as to, can the market sustain these current highs? And the indicators that we have, or the answer is yes. And we've gone through a lot of the detail as to why. And I'm happy I've actually posted all of this data on the blog already, and I'll continue to do so as we go forward. But I did mention, and I want to mention again, the big, most critical piece of information that we did put a post on here was that there's a theory that it's called the Dow theory, still on a buy signal. And real quickly, again, this theory says that when the industrials and the transportation averages advance together, particularly reaching new highs in price, the markets continue to go up. And it also suggests that it's a good buying opportunity for the markets. So prior to the break, we were reviewing another market expert's opinions on a recent interview on CNBC as it relates to how he feels the economy's doing. And I wanted to replay some of the questions that he was asked, because a lot of those questions are very similar in nature to what I've been talking about today. And I wanted to, compare and contrast another expert's viewpoint so that you could have the second set of eyes, and it would verify really what we're talking about. And prior to the break, I was speaking about his view on monetary policy and on housing. But at the moment, I want to get into what he talked about with regards to junk bonds. If you followed the bond markets as of late, it's been a very unusual market in that there's been nothing to buy and there's been nothing to sell. Interest rates are essentially so low that bond markets just don't have any value because there's no income that can be derived from those bonds themselves. So there's been a large push into high yield bonds, aka junk bonds, as a means to find value, and they've been able to sustain their pricing because there's been demand for those bonds, particularly in light of the fact that their yields are higher. But can that be sustained going forward? Well, he took a firm stance against the value of corporate credit this year, calling much of the investment grade and high yield sectors overvalued. But a mild junk bond sell-off this summer made them less highly valued. And, he feels that it's probably a safe place to go back into and play. Again, if we're thinking that interest rates are not going to rise at least until the first quarter of 2015 or maybe beyond, and even if they do rise, as we mentioned, it's going to be at such a slow and measured pace that it's not going to wreak havoc on the bond markets. It makes complete sense to stay in high yield and take advantage of those rates prior to any increase in the bond market. Now, going back to what I said before the break, typically high yield also has the longest duration or longest maturity in order to achieve those rates. And that being the case, those are the bonds that are going to get hurt when interest rates rise, if you go back to my example of the seesaw. So staying the course with that in the short term is definitely a good idea, but it has to be watched. It has to be watched carefully as it relates to the sensitivity of interest rates. What about a stronger dollar? Is the stronger dollar here to stay? Well, his interview revealed a surprising call. He expects the dollar to strengthen substantially against the Japanese yen, which is likely to continue to be devalued. And eventually he sees the dollar yen rising to 200, okay? It was 106 last week. So you're seeing a 50% decrease in the value of the yen against the U.S. dollar, value of the Japanese yen. And I think that speaks to what's going on in our economy versus what's going on in Asia, as our reliance on those countries has weaned and our manufacturing has continued to be more robust. In terms of other value and other assets, and while I'm speaking macro about the economy, he did say that in the past he has taken positions on specific stocks like Apple for a little bit of value and Chipotle. And he's talked extensively in the past about gold and Bitcoin. I'm not going to talk about Bitcoin because I just don't believe it. Well, actually, you know what? I will. I don't believe that you can create a virtual currency that can actually sustain any kind of value going forward. Now, at the moment and for its entire existence, I've been proven completely wrong. But I just don't believe that a virtual currency has any kind of viability whatsoever. I particularly don't know how to equate its value relative to GDPs of different countries, its value relative to what a dollar versus a pound sterling or a Japanese yen would be worth. But again, I seem to be mistaken in that, and it seems to be working. But the big winners, he believes, right, going forward. So let's talk about the big winners. So I talked about a couple stocks, but I don't really want to focus much on that. I want to talk about his big winners in the bond market, because no one really feels there's any value there. And I think this is critical. I mean, you have to have a percentage of holdings in fixed income. And let's talk about his fixed income. The big winners are this: hybrid convertible bonds, which have risen in line with equity strategies this year. Junk bonds were a big winner last year. They're going to be a lesser winner this year, but still a winner. Emerging markets have been strong this year, although they lost last year. We made a pretty heavy bet last year on global bonds, and we didn't do too well in that regard. However, we've stayed the course, and we've made a pretty much of a recovery. But it's definitely something you want to look at, particularly in emerging markets, Brazil, China, Japan, Vietnam, India. Those have been great. I mean, countries like Australia and Germany, their bonds have been stable as a rock, as their economies are extremely robust. But the emerging markets, there has been some great opportunities for some good debt in those areas. The last thing I was going to tell you is corporate, international, developed markets, mortgages, government bonds. They're all up on the year, but they're not necessarily up they're not necessarily equating to any kind of yield whatsoever. And if you're a yield junkie, this is probably going to be the last place that you're going to want to play, because you want to still stick with the convertibles, the hybrids, the junk bonds, emerging markets debt, the things that are going to give you some stuff. And interest rates are down, but the bond market's been really interesting. The last thing I want to tell you about is we looked at a report. And the last thing I want to talk about as it relates to the markets is we looked at a report, and it talked about this: the bearish sentiment. Okay, the people that are the most negative on the markets are at their lowest level since February of 1987. Okay. So the big news, if we think about that today, is from the economy, or is it the number of bears in the U.S. Advisors Sentiment Report came in at their lowest level since February of 1987 at just 13.3%. Today's investors' intelligence readings, as well as those we highlighted, okay, we look at in the past, suggest that there is not a lot of short-term market timers. There's not a lot of bearish investors in the market. And the reason is, and the reason why it matters is this, is because there's several polls that we use as a contrarian indicator. The thinking goes that if there are no bears left, then we could be near a major peak, as there is no one left to buy, as everyone is bullish. So the interesting thing, again, in talking about the markets, is that when people talk about volatility, there has to be a buyer, there has to be a seller. If there wasn't, there'd be nothing to buy, nothing to sell. Well, the bears are the people that are the sellers, and they're the ones that are wanting to get out of the market. Well, if everybody's bullish, then the theory, and if it was 100%, the hypothesis was 100% correct, no one would sell if they were all bullish. So the intriguing thing is that there's a very low level of bears in the market, which means there's a very low level of sellers, which supports higher pricing in the markets. So the last thing is the polls. This poll that was written, this U.S. Advisor Sentiment Report, said that it looked at what newsletter writers are actually thinking. So they're not just necessarily looking at what the buyers and sellers of the market, but looking at what the writers are thinking. And then the fact that the last time the bears were beneath 14% was 87, you have all the ingredients for an intriguing headline for the writers. So now, before you go and sell all your stocks, the S&P gained 16.6% the 6 months after the February signal in 87. All right, we had a big crash in 87, but there were some spectacular gains. That was in October, but there were some spectacular gains to be had for a long time before we had a crash. So the point here is it's hard to truly quantify exactly what this means or when it truly becomes bearish. I mean, I understand it's a major concern of everybody, as too many could be getting excited right at the wrong time. The best time to have been buying was probably a month ago when everybody was in a panic and that long-awaited 10% correction was finally coming. But going back to 1970, this report looked at all the times the bears dropped beneath 14% since 1970. Okay, most of these happened in clusters. So if you look at just the first signal, there had to be at least 2 months go by without another signal for the next one to count. And then this happened. So pretty weak signals across the board indicate there's going to be a great return on the market before there's a massive correction. So the point here is the bears believe that while there's so many bullish people out there, okay, if there's going to be a correction, it's going to be short-lived, and there's going to be a big run-up in the market prior to a massive drawdown. So even the bears are thinking that there's money to be made in this bullish market. And so I'm going to finish on that and come back and talk about what could go wrong in the market, we believe, here in the fourth quarter, and what's going on with savings. I'm going to do that in just a minute. You're listening to the In Black and Weitz radio program on Voice America Business.
Voice America Business Network, the bottom line in business.
ERISA 408B2, fiduciary standards, safe harbor, fidelity bonds, record keepers, discrimination testing. I am so confused.
Does your 401k plan have more questions than answers? Peter Weitz and his team of 401k experts have a solution. Their on-site service model distinguishes them from other service providers, and they are specialists in 401k costs, regulations, and compliance. If your 401k plan has more questions than answers, then contact Peter at 877-945-2888 or email him at peter@inblackandweitz.com.
Climbing Mount Everest is an amazing feat, and many have died trying to do so. However, more people have died descending Mount Everest than in reaching the summit. Part of the problem may be that people are so focused on reaching their objective that they fail to plan appropriately for what they will do or should be prepared for afterward. Similarly, people are so focused on saving for retirement and reaching retirement that they fail to plan appropriately for what they will encounter once they have actually retired. With 1 out of every 4 65-year-olds today living past the age of 90, you may be retired longer than you are actually working. Have you devised a plan, process, and discipline to ensure that you will not run out of money? If you are not sure what to do, then simply contact Peter Weitz and his retirement team at Fusion Analytics. We help manage human emotions using 3 proprietary investment techniques. Our job is to evaluate the forces that the typical investor can't see so that wealth is preserved and not lost. Find out more at inblackandweitz.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandweitz.com. In Black and Weitz, we win by not losing.
The business community's first choice in Internet Talk Radio. Voice America Business Network.
You are listening to In Black and Weitz. To reach Peter Weitz or his guest today, please call 1-866-472-5790. That's 1-866-472-5790. You may also send an email to peter@inblackandweitz.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandweitz.com. Now, back to this week's program.
Hi, thanks. Welcome back to the program. I'm your host, Peter Weitz. I've been spending today talking about the financial markets, and you know, we think that there's gloom coming, or gloom and doom coming, but yet if you've been listening to the data that I've been spouting out, and if you actually hit the blog, you'll see some charts in regards to the data. There's nothing at the moment that supports a market correction, particularly a large one by any stretch. And, you know, I've been focused on the positives related to the market for the vast majority of this show. I want to follow up before I talk about what could be brewing as a bubble in this market. I just want to get back to the comment I made on Bitcoin. My engineer and I were speaking at the break, and the key with Bitcoin is you know, someone, as he mentioned, mysteriously found in their wallet 5 million in Bitcoins. Well, it just leads to the whole argument of how do you, I talked about how do you value Bitcoin, but how do you actually regulate it to keep it from being completely immersed in the market and, you know, illiquid? And being this is that, you know, the more you dilute it with more Bitcoins, the less it's worth. So how do you regulate who owns and who manufactures a Bitcoin if it's a complete fantasy, virtual play, funny money? And I just can't see its sustainability for the future as a viable means. I mean, I would love to buy something. I'd love to buy everything today with Bitcoins because I feel like I'm buying stuff for free. But I just don't understand how it can sustain its value without any kind of regulatory input in any form or fashion. And that's my thought on that. But last thing I was to tell you is that, you know, we've been talking about this for a little while, and I think it's actually coming to a head. But we believe that there's a new technology bubble that's brewing. We think, you know, tech is, we've been speaking about, you know, the tech markets for years. And if you noticed, there was the largest IPO, I think in history, came out 2 days ago in Alibaba. And we've been talking about how it's possible that Alibaba, which was the largest IPO in U.S. history, coming on the heels of a 5-year 200% move, positive move from the lows of the S&P 500, could possibly signify a peak in sentiment. So following up on this theme, there's an article that we follow some data from Statistica showing how venture capital funding has exploded in the last year. And granted, it's well off the internet bubble peak, but keep in mind that you may have there may have been an outlier in that. So Statistica suggests, and they cite, how over the last few years, or specifically in the last week, venture capitalists in the U.S. have expressed their worries about the current state of U.S. startups and the current state of the U.S. startup community. In essence, what they're saying, we believe, is that startups are burning through too much cash and that the overall amount of risk currently taken on in Silicon Valley is excessive. It's not the first time people have warned about another tech bubble. But, the question is, are these concerns at the moment justified? Well, look at the data seems to suggest that is so. According to Thomson Reuters data published by PricewaterhouseCoopers, venture capital funding in the U.S. amounted to $12.97 billion in the second quarter of 2014, which is by far the highest level it's been since the first quarter of 2001. Compared to the second quarter of last year, venture capital funding jumped 81% in the second quarter, representing the highest year-over-year increase since the third quarter of 2000, when venture capital funding reached its historical peak. So if you think about that, the second quarter of last year, venture capital funding jumped 81% in the second quarter, which is the highest year-over-year increase since the third quarter of 2000, which was right before the bubble burst in technology. So interestingly, again, is that the number of VC deals hasn't increased as much as the total amount that was invested, indicating that the average value per deal has increased. And it has. At $11.64 million, the average value per deal was as high in the second quarter of 2014 as it had been in the fourth quarter of 2000. So, while these numbers don't necessarily mean that we're in a classic dot-com bubble, they make one thing perfectly clear. The period of prudence that followed the financial crisis of 2009 is officially over. And it's important to really keep a close eye on these bubble stocks as the venture capital continues to burn into companies at a pace that's equivalent to what we saw in the late 2000 prior to the last tech bubble. I want to close with a quick statement about retirement savings. And we talked about this a couple shows ago, but there was a great graph and I posted it on my blog. What percentage of your gross income did you save for retirement? I'm just going to give you a couple of data. People in their 20s and 30s in age, 51% did not save for retirement at all. What's interesting is people in their 50s, right? So move ahead, 20 or 30 years later, 22% still didn't save for retirement at all. In their 40s, 25% didn't save, and in their 60s, 42% didn't save. So it's amazing. People still aren't saving money, right? The highest level of saving, 24% was the highest level. In people in 30s, 24% saved between 6 and 10%. In their 40s, that number rose to 34%. And in their 50s, that decreased to 29%. And so the point is that people aren't necessarily saving so much. If you follow what some of the experts say with regards to saving, you should probably put away between 10 to 15% annually your income in order to have 80% of your available income to use for retirement. So let me say that again. If you save between 10 and 15% of your annual income, that should equate over an entire working career about 80% of your highest income while you're employed. And that's assuming you start in your 20s or 30s. If you start later, then that 10 to 15% number has to grow in value. So it was an interesting statistic. I posted it on the blog. You can see it there in blackandweitz.com, along with all the rest of the data from today's program, because it's just shocking that, we just don't save enough. I did allude to a higher savings rate in the beginning of the show, but the numbers don't necessarily support that. If you have any questions, please feel free to email me at peter@inblackandweitz.com, or you can find all this information on our blog, http in Black and Weitz. Weitz is spelled WEITZ.com. And you can also find me on Twitter at Peter Weitz. But I spent today talking about the market. I hope you certainly found the data to be interesting. It is all available on our blog. And if you have any questions, please feel free to contact me. Thanks for listening. You've been listening to the In Black and Weitz radio program on Voice America Business. Make it a great week.
Thank you again for tuning in to In Black and Weitz. Please join your host, Peter Weitz, again next Tuesday at 10 a.m. Eastern Time and 7 a.m. Pacific Time for another edition of the program on the Voice America Business Channel. Have a safe week.